If you own a bond fund in retirement and think it's the same as owning a bond, there are two critical differences you need to know. Now, a bond is a contract. You lend, let's say, $10,000, and the borrower will give you $10,000 back at the end, at the maturity date. And let's say interest every about 6 months. It depends on the bond. Now, a bond fund is a group of bonds. Let's say it's a 10-year U.S. Treasury bond ETF that holds 10-year U.S. Treasuries, and it will always hold 10-year U.S. Treasuries. When you own a bond, the bond will eventually mature sometime. The fund will not. It will stay in 10-year U.S. Treasuries. So, now, there's a critical difference between that and owning a bond. Looking at this chart, this shows that this is IEF, the iShares 7 to 10 year Treasury bond ETF. And if you own a bond versus a bond fund, you don't know at maturity how much money you're going to get with a bond fund because there is no maturity. There is no maturity, so you'll have to sell the fund. Now, this could be a positive or a negative. If rates are low, it's probably going to be a negative. If rates are high, it could well be a positive. Now, look at this we'll take from August 2012 or October 2012, and let's look at the U.S. 10-year Treasury rate from then. That was it was about 1.5%, a little more than 1.5%, 1.6%. So we take that from here, and we say, over the next 10 years, what happened? You were up about 3% in this ETF. And rates went from here being 1.6% to, in October 2022, let me just get that up. In October 2022, being around 3 to 4%. And looking at this, you would have made about 15 to 17% had you held the bond directly. Here, you only made maybe like 3 to 5%. Now, the opposite happens when rates go down. You would make more money if rates went down. For instance, let's say you bought here. And in 2034 you sell. Let's say rates in 2034 are 1% or 0%. You'll have made in the bond fund, the price will have gone up because they were able to buy more bonds with the funds from the bonds that they sold. However, if you own a bond, it will give you exactly what you bought. So it's a two-sided thing, like most things. If you buy and rates are high, then you can make more money. If you sell when rates go from being low and then they go to high, then good chance you lose money. In a bond fund. In a bond, it's way more deterministic. You know exactly what you're going to get. Now, there's a second downside of owning bonds, and this is more for passive funds. If you want a passive bond fund, then it's buying the debt of the most indebted companies. Take, for instance, an S&P 500 index fund. It buys the largest companies, which are generally the best companies out there. And it buys those in the largest weights. With a bond fund, it buys the companies with the largest debts. It buys debts in the companies with the largest debts, which are the companies that are most likely to default, which turns out it hurts their returns. So if you're looking at, for instance, a corporate bond ETF, if it's a passive corporate bond ETF, then they're likely concentrated in worse credit quality than average, simply because if you look at if you look at how much debt is issued by the bad credit quality companies, it's more than the good credit quality companies. Because the good credit quality companies have strong earnings, maybe they don't have to issue debt. Now, why do bond funds get recommended? One, they're instant. You buy hundreds of tickers at one time. In retirement, when you're spending down your portfolio, bond funds offer significantly less certainty as to how much money you'll receive, and frankly, you want that in retirement. If you're using certain strategies, then that a bond fund completely does not work with those strategies. Now, there are many times when you should use a bond fund versus a bond, or it would be better for you to use a bond fund versus a bond. But there's certain things that we covered that you have to just pay attention to. Now, what you should actually consider is understand what you own. You should always have either an advisor, or if you're doing it yourself, you should know exactly what you own, why you own it, and what the future prospects for that are. And then consider a bond ladder for income that you depend on. Let's say you buy a 10-year bond or a 5-year bond. You can have it so that will cover the income 5 or 10 years into your retirement. When matures, and you can buy, you can move from stocks into extending your bond ladder. And the third is just make sure you're using the right tool for the job. If you're using a bond fund, and you should really be using a bond, then that can hurt you. So know exactly what you're doing and why you're doing it. And don't do it because some random person on YouTube said, oh, bond funds could be worse in these situations. Do it because of your situation. There are good sides to bond funds, and there are bad sides. Like Thomas Sowell said, there are no solutions, there are only trade-offs. Pay attention when someone says add bonds for safety, but don't just add random bonds. Add it in a nuanced, thoughtful way. If this was useful, share it to someone who's near retirement. They may not have heard this. Thanks.